Hello everyone and welcome back to my channel. I hope everybody's having a great weekend. This week we are actually going to be talking about tax returns, with it being tax season, and opportunity costs. And we're also going to talk about why you do not want to get a large tax return. Don't do it. For those of you who are new to my channel, my name is Paul Novak, and I absolutely love saving, investing, spending, and talking about money, and that's what we're going to do today. Hopefully you're learning from this channel, and if you are, I'd always encourage you, smash that like button and subscribe. If you do have comments, topic recommendations, questions about any of our content, do not hesitate to post them down below. I respond back to all comments. And then if you're interested in starting to save or invest, I'm not going to go through them all, but I've got a ton of different links posted below. If you click on any of those links, there's free stocks, free money, a lot of sign-up bonuses that you can get. Please remember, I'm not a financial professional. I'm just a guy on the internet sharing the tips and tricks that I've learned over the years to try and help others. I'm not affiliated with anybody, and I only cover content or products that I actually use myself. So with that being said, let's get into it. First this week, I really want to talk about just what the term opportunity cost means. And if you look, I've actually got it posted right here on the screen. I pulled this definition right from Investopedia. And as you're going to see as I get further into the video, really the way I'm describing opportunity costs in the context of taxes is the interest that you're giving up by getting that large tax return, right? Because if you don't get the large tax return and you get more money on your paycheck every single pay period, you can invest that money throughout the year, and that investment is going to earn money that's going to get you additional income. And I'm going to show you a visual example, because to me, I learn better from watching visual examples than watching somebody talk. So with that being said, I'm going to pull up the example now. All right, so here is the visual example that I wanted to talk through. And like I said, right, I just like a visual example better. I learn better watching this way. And as I explained it, opportunity costs are going to come from the interest that you're losing out by getting the large tax return. So as I go through this example, and if you've watched my other videos, you've seen these four quadrants before, right? But when I look at, the four quadrants, if you get the tax return, it's coming through as income, right? So that's one of your options. When it comes to opportunity cost, right, your other option that you could do is increased pay, right? So if you're not getting this large tax return at the end of the year, what you're going to end up getting is more money on your paycheck every single week or bi-week when you get paid, right? So that increased pay can ultimately turn into investments, right? So instead of getting this lump sum at the end of the year, we're going to take out this extra pay and we're going to invest it throughout the year every single time we get paid. And it's a strategy I use and really believe in. It's called dollar cost averaging. But what's going to happen is, as you convert that pay into an asset by putting it in investments, those investments are going to end up generating cash. And that cash is going to come back up in the form of income, right? So when you get this tax return up here, you're forfeiting the increased pay, which you could convert into investments, which equals more money that's going to come back into your income. So really the way I explain opportunity costs, and it goes both ways, right? If you are taking the increased pay, your opportunity cost would be the tax return, what you're giving up. I would argue most people enjoy getting that large tax return at the end of the year, and by doing that, they're forfeiting that investment and that additional income that could be coming back in. All right, so now that I've explained how these opportunity costs work, what I wanted to do is go through a couple different examples and actually put dollar figures behind it. So I went on Bankrate, did a little bit of research, and saw that the average tax return last year was about $2,800. I also know that when I started out, had my first real full-time job, my tax returns were anywhere from $1,000 to $1,200. And now, right, that I'm getting older in age and some of my friends are having, kids and different things of that nature, I've heard of tax returns being all the way up to $10,000. So the examples that I'm going to cover are kind of a breakdown all throughout that spectrum, just because I understand everybody's situation is different, right? And some people ask, How can my tax return be $1,000 when somebody else's is $10,000? And there's a lot of different factors that go into that, right? I'm not going to cover them all, but some of them could be your income, how many kids you have, or if you even have children, right? Are your kids in daycare? Is that tax write-offs? Are you a homeowner? What are your property tax rates? Are you going to school, right? And the list goes on and on and on and on. Another thing too is how many deductions you claim, and I'm actually going to walk through the deductions because that's an important part later here in the video. All right, so now I actually want to go through the specific ways that people are giving up money with that opportunity cost by taking the large tax return. I'm actually going to go through the calculations. All right, so now we're going to get into actually calculating these opportunity costs with the tax returns, and for me, I always like getting to look at the numbers. I want to be able to understand how these figures are being calculated. So I thought I'd just briefly share that with you guys as I go through this. I'm going to do 3 different examples because everybody's situation is different. So as you can see here, as I click on the screen, I'm going to do an example with somebody who gets roughly $1,000 tax return. I'm going to do this example for somebody that gets a $5,000 tax return on average. And then I know there are some people out there that are getting around $10,000 for tax returns. So I kind of wanted to break it down into those 3 categories just so I have information for everybody. And I'm going to start up here with the tax return. And I'm going to start with the $1,000 one. And as you can see here, I'm going to break it down for 10 years. Obviously, the time horizon could be longer or shorter. I'm just doing that to keep it simple. So I'm actually going to put in negative $1,000, and I'll explain that as I go. I need the numbers to be negative when I do my investment calculations. So current investment, this is year 1. We're assuming we're starting with no money, so I'm not going to put anything in there. Money per paycheck, again, just to keep this simple, I'm going to do biweekly pay periods. So I'm going to assume that instead of getting paid that tax return as one lump sum at the end, we're going to take that $1,000, we're going to divide it by 26 pay periods if you're getting paid bi-weekly, and that means you'd actually be having an extra $38 and roughly 46 cents per paycheck. Now, again, just to keep this example simple, let's just assume that you could get a 10% return on that money. And what I need to do is I need to break down that percentage per paycheck because we're actually going to invest this per paycheck. So I'm going to take that 10% return, divide it by 26 paychecks in a year, which gets me down to, if I was to get 10% return for the full year, that comes out to 0.38% per paycheck. Annual pay periods, so we already talked about that. If we were going to do bi-weekly, that would be 26. And now when I get into my return, I'm going to use Excel because there's a bunch of math and I don't want to do it all. So I'm going to go in here, and the function I'm going to use is this FV function, which stands for future value. So I'm going to click on that. And as I've stated, I've done this in other videos as well, kind of how this calculation works. Here's the information that I'm going to input. You can see here that rate, NPER, and payment are highlighted, and that's because you need to have at least those 3 in order to do this calculation. And if you have any questions as to what they mean, they're down here below. For rate, it's the interest period rate per period. So we are going to be depositing this every single paycheck. That's why I had to do this per paycheck APR. So for rate, I'm going to click on that number. NPER is the total number of payments in the period. So again, if we do this for the full year, there's 26 paychecks in a year. So I'm going to click on that 26. And then my payment number is going to be how much we're putting in each paycheck. Now, you notice that I had those numbers set up as negative, and this is how I always explain this when I go through this calculation. Imagine you had that $38.46 today. It's in your hands. But once you get paid, you're actually going to take it out of your hands and pay it to the investment. Because we're giving it up to the investment, that's why the number's negative. And when we do that, I'll click OK, that's actually going to give us a positive return, right? So you might be thinking, that's not that much money, right? For profit, I'm just going to take And because the tax return I've got is a negative number, I'm just going to take what the return was and I'm just going to do plus the negative number, which shows that for the end of that year, you profited $49.59. Now, again, that's not life-shattering money, right? But the opportunity cost in not getting that tax return at the end, but investing it through the year, turned into $49. Now, how we're going to show this compounding is, and I need to get a negative number again, but I'm going to actually carry that value over. So let's just take this profit, and this will make sense as I do the calculation again, and let's just times that by -1 just to make the number negative. So now if you got that lump sum payment, you got your $1,000 tax return, that's all you have. But if you go through this and invest it throughout the year, you end up with, just to keep it simple, $1,050, right? So what I'm going to do for opportunity costs is I'm going to assume at the end of that year again, we spend the $1,000, right? So all that you have left then is what it gained. So I'm going to carry this $1,000 over, right? So how much we have per paycheck's the same if our tax return's the same. I'm going to assume that the interest we're getting on these is the same, so I'm just going to carry these over. But now this time when I do this calculation, still going to stick with future value. I've got my rate, it's going to be that 0.38%. We've still only got 26 payments in year 2, so that's not going to change. My payment is still going to be the $38.46, but this time, because we made money last year, we'll invest that money as well. So I'm going to put that in. And then we can carry this over. And you can see now this year we've got $104 extra, right? So this money's going to continue to grow. Because if we do this, and again, I'm assuming at the end of year 2 again, we get that tax return, we'd still spend the $1,000, right? So I'm not looking at us investing all of the money. I'm only looking at us investing what we've made. And then just to keep this simple, I'm just going to carry this all the way out because I think now at least you've seen both examples and how it's done. So as I keep carrying this over, this should start to auto-populate. Just want to make sure that the values stay the same. Still 26 pay periods every single year. Total returns we'll put in here. And then we'll carry over what it's made. So as you can see here, right, what I want to show is at the end of 10 years, you've actually made $809.37 if your tax return is $1,000 a year by getting that money on your paycheck and investing it versus just letting it sit, right? So that true opportunity cost over 10 years comes out to $809. And now, because I have all these formulas set up, without going back through all this, I can just say, hey, for $5,000, and carry this all the way over, right? Your opportunity cost is $4,046.84. So again, here now on a $5,000 tax return, we're up to almost just a little over $4,000 you're giving up by taking the tax return versus reinvesting that money. You know, in here I'm going to do, let's do $10,000. So I'll put in the negative 10,000, right? Carry that money over. And here again, we've got, you know, $8,093.68, right? So you can see how by taking that large tax return and spending it, right, and not investing it, how you're losing out on money. And obviously the longer we go, that number's just going to continue to grow at a more rapid pace. So yeah, those are the calculations and kind of how you can calculate what your opportunity costs are specific to taxes. All right, so now that we've gone through those calculations, I'm actually going to show how I would invest that money, and I would put it in something that's relatively safe. I'd invested in a market average ETF. The one that I recommend is VOO. If you're interested in how to get started doing that, I'll actually place a link down below to my video Investing for Beginners as one option for how you could invest. And you can just see in going through that video, right, how that money really adds up over time. Another thing that I want to talk about is, so if I said, instead of getting the large tax return, if this is something that you're interested in wanting to do, you've got to find ways to scale that tax return back, and some people just aren't familiar with how to do that. So the biggest thing that you can do is change your claimed allowances. And I'm going to show right here on the screen, because I can actually log in to my account through work online and see what my allowances are. I currently claim 2. I claim 2 for federal and 2 for state. And how that works is if you claim 0, they're going to take the most amount off of taxes, which is going to give you your biggest tax return. The more allowances you claim, the lower that they're going to take off of your taxes, but also the smaller your tax return is. And honestly, if this is something that you're interested in doing, I would encourage you to work with your HR department. They're the ones that you actually do the paperwork and stuff to change up what those allowances are. And if you want to know how to get to 0, the best advice I could give you is work with a tax professional, right? Work with the person that does your taxes. They can give you advice for what you should be claiming to try and get that down to 0. And another thing that I want to cover is if you do claim too high on your allowances, it is possible that you pay not enough in taxes, and at the end of the year, you actually have to pay in. Now, I haven't done this myself, but going through this video kind of makes me think, why wouldn't you want to do that? At the end of the day, you could take that money that you're not paying in taxes, invest it throughout the year, make money on it, and all you'd have to pay in is your fair share. It's an interesting concept. I'm just trying to stick with 0 so I don't have to pay anything in, but just going through this video kind of got me thinking, maybe that isn't the worst option in the world. So another option too that I want to say is, whenever you're talking investing, there is always risk, right? So I assume 10% returns. If you do take that money and from your taxes and actually invest it into the market, right, there is a chance that you could end up losing money. And for some people, that's not a risk they want to take. And I don't blame people for feeling that way. Everybody's risk tolerances are different. But another strategy you could use, obviously your returns are going to be less, is instead of taking that money and investing it in the market, you could take that money and put it in a high yield savings account, right? So you know that it's safe. You're still going to be making interest on that money. It's just going to be smaller returns. And if you are interested in opening a high yield savings account, I have an awesome video on Yoda savings. It's just a different way to save. I'll place that link down below, but it's a much safer strategy for investing versus taking that money, let's say, and throwing it into the market. And hopefully today, watching these videos, you found the information helpful. If you do, as I always state, smash that like button and subscribe. Comments are always welcome. And if you're interested in investing or saving, like I said earlier in the video, I got a lot of different links down below. Please remember, we do these financial education videos on Saturdays, and then we do portfolio reviews on Wednesdays. And hopefully I'll see you back here next week where we're going to talk more about saving, investing, and spending money. Have a good weekend.